Welcome to the Private Equity Exchange 2007, the only summit bridging the gaps between limited partners, private equity funds, corporate executives, and entrepreneurs. The Private Equity Exchange is the only venue where LPs, private equity firms, corporate executives, and entrepreneurs meet, enabling them to move quickly from ideas to deal crafting. The Private Equity Exchange, the largest private equity event in Europe for CEOs, funds, and LPs. LBO for professionals. Great insights from private equity leaders.
Just give you an idea of why we're talking to you today about insights into the market. We operate in the M&A, debt advisory and management advisory space, and we're doing about a deal a day across the globe. So that gives us a good context in which to get an overview of the market, and so we'll be sharing some of those insights with you this morning. The first question that I wanted to talk to you about is really just to take a step back. We hear a lot of talk about the credit crunch, and to think about how did we get here. And there's an important distinction to be made, which is the issue isn't a solvency issue with leveraged debt, the issue is one of liquidity. If you go back about 10 years, nobody was talking about CDOs, and if you go back to 1999, they were 4% of the liquidity in the market for leveraged debt, so pretty much inexistent. Before the credit market popped in the LEV market, CDOs were 70% of the liquidity driving LBO debt. And that was putting a lot of fuel into the private equity engine. Now, what happened? Did LEV debt start defaulting? No. What happened is that CDOs, which were basically packaged LEV debt, were living their life fairly normally. Abnormally for some, given that it was driving crazy debt conditions, but there were no particular defaults. But what had happened is people had used similar vehicles, SIVs, to package debt for US households' mortgages. And defaults on those mortgages resulted in a lot of financial investors in SIVs losing a lot of money. And if not more importantly than the money they lost confidence because somebody had got SIVs massively wrong. Was it the rating agencies? Was it the institutions packaging them? Was it people buying them and not understanding what they were buying? Those are all big questions which are only partially answered, and they've resulted in a massive loss of confidence of the investor community in these structured vehicles, as a result of which they pulled out of CDOs. And that is what's created this liquidity crunch, which has taken the fuel out of the private equity engine. But it's an important distinction to be made that it's currently not an issue of solvency, it's one of liquidity. And we'll be moving on to some questions later on to see where that's taken us to and where we might be going.
Thanks, Tarique. Antoine, would you like to say a couple of words about where we are in the market right now?
Yeah, sure. Is this working? Yeah. First of all, hello. My name is Antoine DREAN. I started a company called Triago 15 years ago now, which gives us some visibility. Triago has been raising money for private equity funds, over 120 funds so far. And we are also one of the very large players on the secondary side, helping limited partners sell limited partnership interests. We are based in New York, in Paris, and in Dubai, and have 25 people. So that's for the commercial. Now, maybe where's the market today? Well, obviously, it's no big surprise that the market has changed radically over the last few months. I think for us, one of the what we're seeing is that on the primary side, many LPs were already trying to invest in other funds than just pure buyout funds, and that was already the case before the summer. As some of you may know, we're raising a lot of money from high net worth families around the globe, and these people have been telling us over the last 3-4 years already that they didn't want to invest in buyout funds anymore, especially some of the very large ones, because they felt that they could get, let's say, 2 times their money with a high risk. And these guys were already looking for different things, such as distressed already, such as niche funds, and a lot of value activism. So that's been, I guess, that's really one of the things that we're seeing now. And obviously, these people want less and less and are looking for other funds. What may also be of interest at this point is what's happening on the secondary market. Most of the LPs around the world are now using the secondary market as a great tool to manage their portfolios. And since September, we've seen more and more sellers come to the market with many LP interests, especially again on the buyout side. So basically, at the end of the day, I think we're entering a new era. Private equity, especially on the buyout side, was almost too good to be true for the last 2-3 years. And we're now going back to basics with real value builders and probably much, much less leverage in deals.
Thanks very much, Antoine. Yves, why don't you tell us who you are and where you see the market right now?
Okay. Good morning, everybody. Is it working? Yes, maybe. My name is Yves Alexandre. I'm Managing Director at Investcorp. First of all, Investcorp is an investment firm with specialization in alternative asset classes. We have 5 lines of business in North America and in Europe, covering private equity, real estate, hedge funds. We have a fund also in the Gulf region, and we have a technology fund. So it does fit with the convergence of skilled talents and trends that we were talking about this morning. In terms of private equity, we've been in business for 25 years, both in North America and Europe. So we have a little bit of gained a little bit of experience in both markets, and we are witnessing some very interesting trends right now. In terms of our specialization, we are a mid-market firm, so we will not be here. I will not be here to be with you to talk about the mega deals, the mega funds, and things like that. We are a mid-market firm, which we define a transaction less than $1 billion, so upper mid-market. We also are pushing forward a model where we spend a lot of time working out with the companies how to create value, having the right resources to help them create value, and doing the work, again, as described this morning in the presentation, how important it is to fully understand what is happening in the companies you invest in. So before I talk about the market, I think it may be easier for Jean to introduce himself, and then we can comment about the threat that we are seeing as sponsors and lenders, and also the opportunities, because there are plenty of them.
Thank you, Yves. So good morning. My name is Jean Eichenlaub. I'm the founder with American Capital of a company called European Capital. European Capital is a listed company, listed on the London Stock Exchange. We started the company about 2 years ago. It's important that you understand perhaps the positioning was a little bit different from the usual funds. We do 2 things. We do what is called integrated finance, which means that when we acquire a company, we do the complete balance sheet of an acquisition. So we do the senior debt, the mezzanine, as well as the equity. So one first, I would say, tool that we have at European Capital. The second one being mezzanine for third parties. So the company has opened the first office in Paris about 2 years ago. We opened afterwards an office in London, Frankfurt, and Madrid. We are about 70 people today in Europe. We have the market capitalization of European Capital is close to 900 million euros today, about 2.3 million euros of liquidity. I think the important thing the message I want to give today is talking about the mezzanine. I think the world has changed tremendously over the last few weeks. I gave this example this morning to my colleagues before we started to come to talk to you. Just before the summer, we used to have the investment funds who used to call me and say, okay, Jean, we have a deal for you. Can you do it for us, yes or no? And I want you to be exclusive. And when I came back from the holidays, I think it's more or less the same person who called me, and he started his sentence by saying, Jean, good morning, how are you? So I found this pretty interesting. We will come back to it afterwards with Yves, but the market conditions on the debt side, in terms of leverage as well as in terms of spread, have changed a lot over the last few weeks, and I think this will have a pretty strong impact on the assets on the market for the private equity.
Yeah.
Thanks, Jean.
No, Jean, I agree with what you said in terms of the way we are engaging in conversation with the banks. It's quite different at times. Times change, but what I wanted to say today is that what we are witnessing is not only a financing crisis. I think it's too easy to say, well, the only issue is that there's no debt available. First of all, there's a liquidity crisis, not solvency, as Tarique said. Solvency, I would say, maybe not yet, because some companies do have substantial leverage, and everything will depend on the macroeconomic trend, and people. Right now, you have quite a lot of uncertainty on that front. When you look at the financing market also, and at the beginning of the month, I think there was a conference here in Paris, and there were other conferences. People were a little bit more cheerful, saying, well, things are getting better, banks are managing, they did manage to offload part of the debt, and it turns out that in the past 10 days, things have changed also radically. So we have to be careful. The volatility of the market is extremely important. So you have the debt aspect, and then you have also for private equity sponsors, there's another issue, which is you need to buy and sell assets. This is our business, and in terms of in that situation, you have a lot of anxiety when you look at the vendors. They don't know really whether or not they can realize a targeted value on the asset they have. I've never seen so many processes being pulled. People felt very confident they can go either through a straight sale or through an IPO market. Suddenly, 2 weeks ago, the IPO market started being a little bit more shaky. As a result, valuation are not as strong as they used to be, and the vendors don't know really whether to wait, whether to go ahead, how things are going to unfold. So this uncertainty, this is what we are witnessing really real time. Then I talked about the macroeconomic environment, which is, in my mind, the most important thing. The rest can be managed, it's very temporary. Macroeconomic environment means that there might be some fundamental changes as to the valuation of the assets that we own. And it requires, to work much harder at those assets and anticipate any kind of downturn. This is, by the way, the instruction that we are giving to every single CEOs of the companies in our portfolio. What are the contingency plans that they have for next year? Because, as you can imagine, this is budget time as we speak right now. The last thing is obviously for the sponsors, and Antoine will be able to comment on that, is when you have less debt, when you have a more uncertain economic environment, and you obviously will have some impact on the returns. Right now, returns are the anticipated returns for sponsors have gone down dramatically. Jean mentioned that debt has increased, the cost of debt has increased, which is understandable. You need to price the risk, but what I've witnessed, despite the fact that risk have increased for sponsors, I still see bids being made or being put on the table at returns which are well below the 20% that people claim they're targeting.
If I could pick up on one of the points that Yves has made there, which is, will we move from a liquidity crisis to a solvency crisis? And thinking about some of the macroeconomic issues that may mean that we'll move to more difficult economic times. There are a couple of points worth highlighting. One is spending by consumers and by corporates is likely to slow because the cost of credit has increased and the access to credit has decreased. And we're seeing evidence of that already. Another factor is default rates. As I said previously, there wasn't an issue on default rates on CDOs. There is evidence that default rates may increase now. The rating agencies are predicting it, but what confidence do you have in the rating agencies, you might say? Perhaps more worryingly, there was some hedge funds that were visionary and took big bets against US subprime, shorting it and made a lot of money out of that. And those same hedge funds are now taking bets against corporate default rates. So if they get that right, then that's probably worrying in terms of macroeconomic signal. We have a backdrop, obviously, of a dollar and a petrol price, which is making life increasingly difficult for a lot of corporates. And then finally, there's the question of confidence. Let's remember that the crisis in the financial economy came out of a confidence crisis. Confidence is hard to call, but it's equally important for the real economy. So that's going to be an important factor as to if there's a downturn and how big that downturn is. And what we can hope for perhaps is a soft landing and riding it out, in which case I think private equity has a lot of opportunities. Private equity has tended to be a smarter investor after market corrections. It's easy to paint a gloomy picture, but private equity has done well after market corrections, and there are a number of opportunities for private equity if they think differently about how they go about their business. And I think we'll talk about some of the things that they can do.
Thanks, Tarique. Yeah, you mentioned opportunities. Jean, how is European Capital viewing the market at the moment, and do you see that the market is presenting you, because of your model, with an opportunity to do something different?
Sure. If I look at the just come back perhaps to some of the comment from Tarique and from Yves. I told you the debt conditions have changed dramatically, really over the last few weeks. In terms of leverage, we've lost 1 to 2 notches. In terms of pricing, we have increased from 100 to 150 basis points. I'm talking about mezzanine paper, for example. Nevertheless, and having said this, the good assets are still being financed. And financed at 7 times EBITDA for the mezzanine. So there are still a few deals being done on the market today. Even although I believe that Q4 is going to be an extremely quiet market for the private equity, at least in France, from what I understood. I understand from my colleagues in the UK and Germany as well. But to come back to Nathan's question, so on the mezzanine side, I gave you more or less our feeling on what's happening on the market. On the doing integrated finance is obviously today for us, during 2 years, doing integrated finance was interesting, but not that much, because on all the processes that were being run on the market, there was a staple financing, there was debt available on the market, perhaps more than what we were willing to do. Today, being able to provide everything, the senior debt, the mezzanine, and the equity, when you want to buy an asset, is obviously I would consider as a big advantage. Having said this, you have to be still very selective on the assets you want to buy, because when you underwrite everything, you've got to make sure you've got a very strong asset, because if you lose, you don't only lose your equity, you lose the equity, the mezz, and the debt. But yes, for us, the market conditions are today better than what they were just before the summer.
Thanks, Jean. Antoine, if I could come to you. We've seen quite a few mega funds raising recently. It doesn't seem to be too much of a slowdown in LP appetite. And I'm wondering, from your perspective, what the LPs are saying about the market, whether they're looking to reduce their exposure or whether they're still very confident in returns going forward in this asset class.
Well, I think that, first of all, most of the announcements that were made recently regarding large buyout funds were actually following commitments that were made before the summer. So I think that if you look at when the money got into these funds, it's not really in September, October, it's rather in May or June, when the same people that tell you today that it's the end of the world were telling you that this was a change of paradigm, etc. This is a tricky word. Usually when people start saying that we're entering a new paradigm, it's usually a pretty bad sign. And I remember that from year 2000, and I think that was it again. So that's on the announcement side. LPs are you basically have two categories of LPs. You have like probably 10-20% that really hunt for good deals, and these guys feel that this is great times for them. Look at what's happening for someone like Wilbur Ross, for instance. I mean, he's probably in good shape right now, and these guys love what's going on right now. If the other 80 to 90% are, you know, the herd, and these people follow each. I mean, they look at what the others are doing, and they do exactly the same thing. So they've been going through the summer without doing much, and as everybody knows, July and August are not closing month. And then in September, I think they started to ask themselves whether this would continue or not. As of today, most of these people are slowing down. I think that 07 is definitely gone as far as fundraising goes. And 08 may be a big surprise. It's, you know, no one really knows where the market's heading, actually. And if someone knows, please raise your hand. It may help a few of us. But as always, when it's easy to raise money, it's usually not easy to make good returns. And when it's difficult to raise money, it's easier to make money. So, at the end of the day, some smart investors may be able to do some great deals in the years or weeks to come.
Thanks, Antoine. So you mentioned smart investor. I think, Tarique, you mentioned distressed debt. Is now the right time for GPs to form a distressed debt fund, or LPs to jump into the distressed debt asset class, or should we be waiting a few more months to see how the market shakes out? What does distressed debt look like at the moment?
I think if you look at the debt market, it's a question of supply and demand. It's a hard market to call, but there's a lot of debt out there which isn't defaulting, which people are trying to get off their books, and logically the market should find the right price for that debt, and there should be opportunities for people who do have liquidity to make good returns buying that debt. Now, they have two choices. They can buy debt that was already in the market, which is Covlight, which was probably underpriced, but is being sold below par. Or they can buy fresh debt that's got covenants attached to it, that's been repriced, and that doesn't have a stigma attached to it, which they can buy through club deals in the commercial market or syndication or through new CDOs. So the market is going to have to find the equilibrium price for the old debt that people are trying to shift off their books, and for the new debt that's being written. If you look at what's happening to the market at the moment, and you look at Q3, you have to distinguish between the segments of the market. There's been a large cap crunch, and that's unsurprising because the large cap was so dependent on CDO debt. That debt, as I said earlier, was 70% of the liquidity. In the small cap, that's held up very well, and that market has been financing itself largely in the commercial market and is able to do so because of the debt tickets. And if you go to the mid-market, it's more of a mixed story. The market was down about 35%, half the drop of the large cap. And that's the larger mid-cap deals that are suffering the greatest, which are the more difficult deals to finance because of their sensitivity to the CDO market. As Jean said, I think Q4 there'll be more blood on the streets because the pipeline of pre-summer deals, in the same way as Antoine said for finance raising, flattered finance raising that we've seen recently. It's also flattered deal activity in Q3.
Jean, what's your take on the distressed debt side of things?
Well, I like to say that France is always 1 or 2 years behind the UK and the US in terms of economic cycle. The US economy started to slow down a little bit about a year ago, and American Capital, who is our affiliate company, opened a distressed activity. It's not called distressed department, of course. It's called special situations department. You don't use the word distressed. They have been the most active guys on the market for the last few months. We are contemplating doing it in Europe. Definitely, two different markets: the distressed market for the debt and the distressed market for the equity. I tend to agree with Tarique. There will be some difficulties because of the oil price, etc. Not sure it's going to come right now, not immediately, because if I look at the portfolio, we have invested in about 26 companies over the last 2 years. The portfolio is doing pretty well today. The impact has not been that bad, even although the French economy is slowing down a little bit. So probably a good time to organize a team today and watch what's going to happen on the market. That's at least our view.
Thanks, Jean.
Yves, what do you think as the equity provider?
Well, I think portfolio for many groups is still very good. Some of the companies did benefit from 1 or 2 years of economic expansion. So despite the fact that they had a lot of debt, they were able to implement some of the initiatives they had to implement, and in order to start deleveraging and create value. At least those who have done that will be fine. They will be fine. What I think is interesting in this kind of environment, because it's very easy to be gloomy, but don't do anything. I think what's important is to understand where the opportunities are. You have a fair amount of opportunities. First of all, the mid-market is quite a big market, especially in Europe. And this market, I wouldn't say it's completely open, because that's not true. Many banks say that they can lend, but it is a little bit more complex. But there are transactions to be done in the mid-market, and good companies to buy. Second thing is you can diversify or get a little bit more specialized. We talked about distressed activity. I think the distressed debt will be more liquid than the distressed equity in a short term, for one simple reason, because you will play just the repricing of the debt. It's just technical. When you can buy paper at 90 and soon maybe 85, just because of sheer repricing of the risk, then you have an arbitrage and you can move into that field. So that's another activity. So I agree with you, Jean. You'll see a lot in distressed debt. I don't know yet about distressed equity. There will be some as usual, but I don't know yet about the amount. You have also other segments, and Antoine alluded to those. You see more sophisticated financing/equity structures being presented. Jean mentioned what European Capital is doing. You can see also some funds moving into specialized sectors, into new territories. People are moving into Eastern Europe. They're moving into Turkey. You've seen the large transactions now being done in Turkey. You see people moving into India, into Asia more aggressively to find new pockets of investment. So that's interesting. What I think there is a common theme in all these situations, which is it's fine to do so, provided you know what you're doing. You heard this morning, I think it was Sebastian who said, real estate is a very good class, but don't get in if you don't know anything about real estate, if you're not experienced. So which is a very, very true comment, and this is applicable to what we are witnessing right now. It's a great period for those sponsors who have the resources and experience to move into those areas. Resources mean the right people with the right talent and experience. They have done deals in those sectors, and they are able to apply a model in order to develop the business in those new areas, in these new territories. It's just going to be a little bit harder to create value.
Yves, you mentioned that the mid-market is still open for business, not too many changes on that side of things. But is there a worry that some of the larger players will move down the value chain because they can't get the money away at the top end, and they will crowd the mid-market? Is that a worry for all of you guys, because you all work in the mid-market sector?
Definitely. Now, first of all, mid-market is open. People are piling over whatever is available. I've seen there's a small transaction in the French market of 200 million euro, sort of, where 40 people were looking at this business. 40. So these are not only some small mid-market fund. Everybody was looking at it. So that gives you already a feeling in terms of what's going on. And also when we talk about the herds and people just following what's happening. Now, interestingly enough, for this 200 million transaction, I have never seen so many banks declining even to looking at this deal. That even banks in the current pool, current lenders of the companies, are not moving at all. That was an interesting phenomenon. I've never seen that before.
And
you
this,
know it.
Yeah, and this whatever the leverage, even at a senior debt at 3 times,
whatever the leverage,
the bankers wouldn't come in, and the asset was of pretty good quality.
It's fine, yeah.
Yeah, I think that's one of the important points on the behaviour of debt in the mid-market is there's a definite flight to quality.
And thanks, Tarique. Antoine, how has the secondary market for LP interest reacted to the liquidity crisis, should we call it? Have you seen a lot of movement on that side of things? LPs looking to shift exposure and the secondary market opening up a bit?
Well, I think one good example is that the market has changed almost overnight is that some people that were not sellers at a 10 or 20% premium in June are now selling at 10 or 20% discounts in October or November. As you all may know, the secondary market for LP interests, and I'm not talking about secondary buyouts, I'm talking about the secondary market of LP interests, has changed quite a lot when in 99, 2000, most European investors decided to invest heavily in private equity and wanted to get more money at work more quickly. So most of these guys decided to buy secondaries instead of primaries to get to their 5% allocation in a shorter period of time. And what happened is that prices moved up a lot, and discounts became premiums. So that was very recently. I think that we're now in a market where the secondary buyers are making it possible the secondary buyers are making it possible for sellers to actually manage their portfolio. And especially in the US today, most pension funds are now going into sales to make sure that their portfolio is well balanced, is producing the kind of returns that they're looking for, producing co-investment opportunities, etc. So yes, there is a big change right now. The secondary market is definitely there to help and is definitely used.
Thanks, Antoine. We mentioned rating agencies, and I know it's quite a controversial topic, but I was wondering, is it fair to lay any part of the blame for the decline in liquidity on the ratings agencies? What should their role be? How much attention do you guys pay to these ratings agencies? Tarique?
It's a big topic, the rating agencies. The rating agencies didn't see the problem coming, did they? Now, there's a number of questions. What's the fundamental role of the rating agencies? It's to look at creditworthiness. Something can be rated AAA and be rated creditworthy AAA. That doesn't mean that the price can't drop. So there's a question to be asked as to, what reliance should we place on the rating agencies? Now, there's other issues with the rating agencies. They didn't see it coming, but there's a lot of people who have enormous financial resources who were paid a lot of money to bet on which way the market was going, such as asset managers, hedge funds, who didn't see the problem coming either. So there's blame to be apportioned, and I don't think really we know the answer to that yet. The certainty is that it has undermined the confidence that people can place on the rating agencies, and that has had a huge knock-on effect in other elements of the financial system in terms of the confidence in the market.
Jean, did you pay much attention to the rating agencies prior to the credit crunch?
Yes, we do, because we are, as a listed entity, we work very closely with the rating agencies. Yes, I tend to agree with Tarique. The rating agencies didn't see the problem arriving, but it's not their job. I think, first of all, it's the asset manager's job, which is our job. The extent of France being affected by the subprime crisis in the USA, frankly, I didn't even know the subprime market existed a few months ago. So it was very difficult to anticipate that this would have an effect on the overall worldwide liquidity of the US banks, which would have an impact on the liquidity of the European banks, which would make that the leverage goes down and the margin increases, and that the world has changed enormously in a few weeks in the private equity market. So no, for me, it's difficult to blame the rating agencies. I think as I said, the economy is going to go down a little bit in France as well. These are our expectations for the coming year. So it's going to be interesting to see what's going to happen. But a lot of paper has been downgraded by the rating agencies over the last few weeks, and I think this is only the beginning.
Yves, do you have a view on that?
My view is that everybody has to do his own work. So it's too easy to put the blame on someone else. And an asset manager and a credit manager, they have to know what they're investing in.
Thanks. So we're coming to the end of the year. What does 2008 hold for everyone? What are the new trends and some of the new players you think we'll see emerging in 2008? What are the things we need to look out for? Jean?
I think for the last 2 years, and European capital is an example. You could do close to everything, like what Sébastien Bazin did this morning. It more or less worked out. The multiples increased in 2005. You used to buy the companies for 9 times. Now it's 11 times to 12 times. So as you know, we create value with multiples, with EBDAs, and with debt coming down. So whatever you did, more or less, was successful. I think 2008 is going to be much more difficult, and it's going to be much more difficult to get equity returns at 20% IRR on vintages of 2008 or 2007. So it's going to be down to the funds to really work on the assets much closer.
Thanks. And Antoine, how are the LPs looking going into 2008? Yes. Okay, I think we're out of time.
Sorry.
Sorry for that.
I don't want to conclude. We should.
Out of time, Pierre. We're out of time. Thanks very much, all the panelists up here, Jean, Tarique, Antoine, and Yves. Are we taking questions, Pierre? We're not taking questions. We can give everyone a round of applause.